So I'm delighted to introduce the 2021 Specialist Lending State of the Nation debate, which, as you'll realise when we go into Q&A afterwards, this is pre-recorded only simply to give you the opportunity to have plenty of time to think of those questions that you want to ask. So this is recorded a few days before the 1st of July, which is when you'll be watching it. Now, I'm delighted to be joined. I'm not sure the way it's going to be on the screen. So if we can start off by saying the hairiest man on the screen, which is Buster Tolfrey with the scary owl behind him. A very warm congratulations. Formerly Commercial Director of Mortgages, now Director of Mortgages, which is a promotion, and rightly so, Buster. So a warm welcome to you. The chap with the second most impressive beard is Joshua Elish from MTF, Director of MTF, that recently have done their MBO. So many congratulations to you and Tamir there. Josh, long-term partner of the business. We're then looking at, well, let's get the other bloke out of our guest first. The chap with the cool t-shirt is Adrian Maloney, Sales Director of the One Savings Bank. Doesn't have one lender, doesn't have two, as he tells me, has three. So Sales Director of three lenders. We then have Caroline Marakian, the the head of national accounts. Sorry, Caroline, I knew there was a head somewhere of Pepper Money. A long time friend of the business. Very welcome to you, Caroline. And last but certainly not least is Emma Cox, the Sales Director of Shawbrook, who's in a very sort of fashionable bijou dwelling there, somewhere very posh, no doubt, according to her. Anyway, it's brilliant. What a brilliant audience. So we've got some great questions today, and hopefully you lot will answer them as honestly as I'd expect you to. Let's get a nice, easy one. Let's start with Josh on this. Are non-bank lenders a bigger challenge to the dominance of the challenger bank than traditional deposit-taking banks?
I think there increasingly are. I think the challenger banks have operated very effectively in the specialist end of the market that has become, increasingly competitive. You'll see the likes of a lot of bridging finance companies who have become incredibly price competitive over the course of the last several years as more and more liquidity has come into the market. We've seen any number of significant institutional investors coming into the space. For example, we secured an investment from the likes of PIMCO, from the likes of Insight. We know that institutions such as JP Morgan are also kind of heavily involved in this part of the sector, which wasn't always traditionally the case. So I think what you've seen is the non-bank lenders, people like ourselves and some of our immediate competitors, have become more and more competitive, more and more price competitive, and we've been able to marry that price competitivity with very, very good levels of service and a slickness that comes from being a smaller institution. So I think the challenger banks, when they're operating in this part of the market, are definitely experiencing more competition than they had previously, and certainly more so than they would do from the larger banks.
So Josh, I mean, it was always perceived wisdom that every non-bank had a direct gravitational pull to either IPO and then become a bank, or to become a bank and then to IPO. Do you think that's still the case? Do you think non-banks all aspire to be banks?
No, I think this is something that we have seen a lot, and you'll have seen other people have done it successfully. So Mast Haven is a good example of someone who went from being a traditional specialist lender, and they ultimately attained the banking license, and then very successfully have gone on to become a challenger bank. But I think increasingly for a lot of the specialist lenders, and ourselves in particular, we look at that model, we look at that dynamic, and we think, it's a very competitive market. If you just look at the people who are on the panel today, there's some really, really strong competitive entities in that space. So why would you want to jump into an already full market? when you look at the capital adequacy requirements of a bank, when you look at the PRA regulatory obligations that you encounter when you're a bank, it kind of really then makes it, a tough proposition. So, I think at our end of the space, at our end of the market, there's a different focus. There's a focus on concentrating on doing what we do well and just trying to do as much of it as we can, as opposed to trying to morph into being something that we're not, and we probably wouldn't do very well anyway.
Okay, fair enough. Emma, I'm gonna ask you, I want to call you the world's first challenger bank. I want to call you one of the world's first challenger banks, because then it doesn't upset anybody. Is the challenge to the dominant middle ground, which makes up a lot of specialist lending, likely to come from the likes of Josh and Caroline, perhaps, than it is from some of your traditional peer group like Adrian and Buster, or even from a new group such as the top 5 lenders? Where is the threat to the dominance in the middle ground going to come from?
Yeah, so it's an interesting sort of perspective, really. So yes, I think the challenge that we see from non-bank lenders is always good, because it does kind of open up the market and forces us to push on and think sometimes outside the box. I think the journey that challenger banks have been on is that we had to kind of adapt pretty quickly, learn very quickly, understand what the market wanted, and be disruptive in the very first instance. Then you have to go through a phase of embedding sort of the regulatory requirements and frameworks, etc. As a bank, we have those responsibilities. We can't shy away from them, so we have to embrace them. Then I think you'll start to see another kind of phase of the challenger bank whereby, and we certainly have the support at the minute, to try and sort of look into new markets. Where are the new emerging trends? How better can we support our customers? And I think the benefit that we have, although there are benefits to being a non-bank lender, to Josh's point, is that we have the scalability. We also have the funding sort of options behind us that kind of make it a little bit more economical for us to kind of put some weight behind the markets that we choose to be in. And then we look to sort of grow within those markets. So I think it's good to have challenges from all corners. I think it keeps us all fresh, keeps us on our toes. I think ultimately we're here to better serve our customers. And without that competitive push from all these, from all quarters, the market would probably just sort of kind of go backwards rather than forwards. So I kind of welcome the challenge.
Okay. I guess it's a bit of blood sport. I can't help ask the question to the other two Herberts in the room, the other two banks. But chaps, where's the challenge to the dominance of the challenge in the middle coming from? Where's it going to come from, do you think?
Do you want to go first, Bust? Or?
Yeah, okay, yeah. Look, I think it depends on what product set you're looking at. I think if you're talking prime mortgage lending, then generally retail funded lenders can enjoy a lower cost of funds, certainly in control of their own funding destiny a bit more than warehouse line funded lenders. But if you look at the likes of like buy to let, for example, I think PRA regulated lenders operate in one sector of the market, which is fairly restricted. You talk about, interest coverage ratios and those sorts of things that don't apply to non-PRA lenders, where they've probably got more flex, probably a slightly wider risk appetite, because it is different if you're, I say this with a bit tongue in cheek, but playing with someone else's money as opposed to consumers' money. So I think it depends on the product. But going back to what Emma was saying, I think it's good and healthy competition across the piece, because ultimately raising the bar in those areas will give a better consumer outcome, and that's what we're all judged on at the end of the day, isn't it? Meeting the consumer's need and giving them a fair outcome. So for me, I think it depends on the product, and certainly some lead itself to more competition from non-bank lenders than others.
Very good. iPad 2.
Look, I think we're very fortunate in the specialist market at the moment to have a complement of banks and retail funded lenders and non-banks. To Josh's point, somewhere like Bridging probably really suits some of the non-bank lenders, and it's good ground to grow in. I think defining what a challenger bank is quite interesting, because if you ask the general public, they say it's the guys that challenge the top 6 in terms of current accounts. But actually, you've got in ourselves a really sizable lender in the specialist market. Top 6 on the UK finance buy-to-let listing. No bank has really challenged the top 6 in terms of buy-to-let, probably like OSB Group has in terms of the way it's combined. But I think the fact that there is so much choice in the different sectors that is complemented by the different types, the different funded lenders, makes this market a really strong and interesting place to be in. And that we see some bits come out from some of the non-bank lenders that perhaps some of the rest of us won't play in. But that's not to say it's bad lending. It's just to say they're exploring other avenues of the market. For me, it'd be quite interesting with some. I think you touched on it, Josh, or Rob. You asked a question about IPO and banking licenses. We've seen a few non-bank lenders go down that journey and haven't got over the hurdle. But what would be quite interesting is the specialist market must be quite interesting to a lot of other institutions, and whether they come in and look at some of the non-bank lenders that are there at the moment and see that as a platform to grow their position in the market over the next few years, for me, will be quite an interesting piece.
Okay. Buster, the second charge Svengali, as you are, Mr. Second Charge, you'll probably win sort of personality of the year in the second charge community on the basis that there's probably not many of you left, to be fair. Will second charges ever regain the numbers pre-2008? What would the size of a correctly functioning seconds market in 2021 be?
So, look, the market has changed a lot in the last 15 years or so. So, kind of, I wish it would get back to pre-2008 when you're looking at 450 million a month of completions. But the reality is, a lot of the practices that went on when the market was that size are things that would be deemed kind of irresponsible lending, or certainly not in the customer's best interests, given how the world has changed. And it's not just seconds that's gone through. You look at, MCD, MMR, the first charge market has changed vastly in that time too. But a lot of that lending did include, let's say, less salubrious, tactics or principles that just don't exist today. So things like self-cert, 125% lending, ID proof with a Boots Advantage card, kind of you name it. We've kind of seen it all back in those days. But the market since 2012, really coming out of the back of the credit crunch, does look quite different than that existed before. And that's probably why it's quite a bit smaller. So it grew month on month. So back in 2012, you're probably thinking 25 million a month. I mean, it's tiny, like almost insignificant. Well, not almost, it was insignificant. And pre-COVID, we were up at something like 115 million a month based on the FLA's figures, which kind of the trade body for second charges. And at that level, that includes residential lending. It includes buy-to-let lending as an element of second charge. But really, you've got to ask yourself, what is the target customer profile? Because it's that should drive the size of the market, in my view. And second charges historically have always been thought of as a subprime product for a subprime market, and that's not really the case. That's probably why the market is now only 115 million and not the 400 it was before. So you're really looking at customers that have got a first charge that's too good to touch, typically. So talking from a UTB standpoint, the vast majority of our borrowers have got a first charge with Nationwide or another prime lender. It's just they've got ERCs they want to leave alone, or they've got a interest only, a really low tracker that they don't want to touch. And raising 50 grand, which is the average size for a second, a slightly higher rate that probably starts in the threes, actually makes good commercial sense. That target customer profile is really no different to a remortgage or a further advanced customer. And kind of, I think what a lot of lenders have tried to do, and a lot of trade bodies have tried to do, and organisations such as yourself, Rob, is push out the messaging for that target customer profile. Because I think if mortgage advisors understood it more, then you'd see it grow more. And that's really the thing that holds it back, I think, in my view. But look, going back to what you actually, you asked, what's a correctly functioning seconds market? COVID hit it for 6, I would say, and it's been slower to recover than we've seen in the first charge market. But somewhere in the 150 to 200 million a month range, I would say, would be a realistic figure for a healthy market, probably over the 2-3 years. Now, it was at 115 million pre-COVID, and I think that shortfall is simply because, bit controversial this, but simply because mortgage advisors will look for the weapon of choice being a 2-year fix and then a remortgage out of the back of that 2-year fix, rather than considering a second charge. So I think if there was more awareness, you'd see more growth. But if we can't get that awareness out there, it's 115 mil. That's where it's at.
So in terms of quantifying the value, the true value, if my words not yours, all advisors doing their job correctly, would be approximately double the size perhaps than it is right now.
I mean, as a stab, I'd say. Yeah. I mean, we you've just got to look at the types of borrowing that go through remortgage activity. If there's a borrower that's paid an ERC on their remo, then was that the right outcome? If they were purchasing up the ladder, it probably was. But if they were raising 50 grand for an extension, it may not have been.
Emma, I'm going to ask you the same question. I mean, to 1.75 to 2.5 billion pounds a year is a correctly functioning seconds market. Was my estimation there. That probably involves Shawbrook doing a bit more, I guess. What is that a fair comment? Would you say that sort of value?
Yeah, I think so. It's interesting to sort of note Buster's comments around the fact that it's a bit slower to return after COVID, as we've seen in other markets, especially sort of buy-to-let. So I think that if we can get to what a corrected sort of marketplace would be, based on the points around intermediaries providing better access and more advice around it, then I think it should be a very sort of viable business to be in. And I think advisors should consider it seriously as part of their weaponry. And I know we've been on this journey before, a few cycles around sort of trying to bring brokers more in the room around seconds and the value that it brings to good customer outcomes. So I think we've got a bit of work to do there. And from our perspective, it's a market that's part of our DNA. We've been on a journey with it, and we continue to sort of push on. But as I said, I think there's a lot of work that still needs to be done in order to really drive the market forward and ensure that brokers have what they need in order to provide the customers with what they need.
Yeah. Okay. Fair enough. Caroline, I'm going to bring you in with a sort of a question just for you, which will probably either delight you or scare you in equal measures. So you guys have done an awful lot of work more recently into the size of the UK non-conforming market, with the amount of people that you're expecting to come into that market in the next 12 months for home ownership. I mean, I appreciate COVID for mortgage lenders in the short term probably wasn't such a good thing because of the payment holidays that were forced on you and all the challenges. But do you think how will then pandemic affect the short-term future for Pepper, do you think? And is this a real great opportunity for you?
Yeah, absolutely. As you know, we continually undertake research, and in our very latest research, we found that there were like 6.29 million people in the UK who've got adverse credit, and actually, I think it was 36% have actually been impacted as a result of COVID. So yeah, there's been a huge opportunity, and it's something that I think we'll see more and more as the year goes on, but also as we continue, into 2026 potentially. But there's like now 880,000 people who are intending to either purchase or to either live in or let out in the next 12 months, looking for a mortgage application. So I think from a Pepper perspective, we're going to embrace that, and for us not to look at it would be a real shame. So short term, medium and long term, I think there's a huge opportunity. But it also goes down to, this is going to be down to a broker not shying away from the specialist advice, or alternatively looking to the likes of Brightstar to be able to support these customers, because, professional advice here is going to be absolutely key to making sure that we're giving them the best customer outcome.
Yeah, absolutely. And for any intermediary that hasn't viewed that excellent study, can they grab that on your Pepper Money website?
Yes, they can. Yes, they can. And interestingly, what it will show is that there's like 52% of people surveyed who were actually concerned that they were going to get a mortgage application declined, but actually in reality, and it goes back to Buster's point around, you know, good customer profiles for second charge mortgages, actually the majority of these people have got good profiles. It's just been, you know, something that just happened that was unexpected, like a divorce, which, you know, we know those things happen, that they've got a blip and actually they were able to have a mortgage. And the reality was that out of all these thousands of people, only 8% couldn't get one. So yeah, we just need to raise that awareness, I think, a little bit more.
Okay. Josh, as Caroline's mentioned the word divorce, I felt I needed to come straight. Really. So look, you guys are, you know, you do loads and loads of non-reg and regulated bridging loans. Should brokers be financially penalised if bridging loans don't redeem on time? A bit like a divorce settlement, you know.
I think the question goes to responsibility, and where responsibility for assessing risk, responsibility for underwriting a transaction really lies. And you know, we're firmly of the opinion that, you know, it's our job to consider a case in its entirety, to assess the risk, to underwrite that risk correctly, and to then either lend or not to lend. And it's the broker's role to package, present, be transparent, and give us all of the information that we require and we need. And then on a go forward, it's really our responsibility to manage that loan. And if we've done our job right at the outset, if we've done things correctly at the outset, then the vast majority of our loans should perform. And ultimately, if they're non-performing loans, I would argue that it's our responsibility and or our fault as a lender because we didn't do our job to begin with. Now, that being said, so I think this notion of like penalizing a broker because, you know, a client and or a lender didn't do their job or didn't perform is a little bit harsh and a little bit kind of arbitrary. I like the idea of creating an alignment of interest. I like the idea, and certainly some brokers we work with sometimes, particularly in order to make the financials of the deal work for their client at the outset. Sometimes they defer some of their commission so that it's payable on redemption. So it's not a penalty at all, but what it does is it ensures that the broker then really stays with his client throughout what is a relatively short loan period. We're talking anywhere between 1 month and 24 months, but then the broker stays with the client and then receives at least part of the remuneration at the expiration of the term. So I like that. I like that alignment of interest, but at the same time, it's not something that we've ever pushed, and it's not something that is market standard. So by and large, I think as long as a lender does their job, there shouldn't really be any kind of issue there. You're always going to have non-performing loans. Every lender in the country has NPLs on their book.
So if you had, when you have non-performing loans, do you look at the source of those non-conforming loans, and if so, if there is a pattern where there's a number of non-conforming loans from the same source, do you then reach the decision that you no longer wish to deal with that source as a result of it because the quality of the business is poor, or is that not the case?
No, we would absolutely take that approach. And again, it's another facet of responsibility. So as a lender, you're responsible for doing exactly that type of thing. You're responsible for assessing and understanding where your NPLs are coming from and why they're happening. And yeah, absolutely. If you have one particular source, and we've certainly seen it over the course of a 12-year history, where you have a broker who seems to systematically be introducing loans which aren't really perhaps, let's say, fit for purpose in the grand scheme of things, or maybe even sometimes it kind of misled us on the journey, which then kind of prevented us from being able to withdraw at an earlier stage. But absolutely, if you have someone who is doing that, then you refuse to work with them. But you undertake, as a lender, any responsible lender undertakes due diligence on the brokers with whom they deal. So we have an onboarding process. We don't just randomly accept applications from any broker in the country without first assessing whether they're FCA registered and regulated. Get a better feel for who they are. You have to in this modern age, even just from an AML perspective.
Yeah, no, I agree. Unfortunately, there are a small number of lenders that whose onboarding process is at best non-existent. Adrian, let me ask you I quite like the idea that Josh said about paying a little bit extra for doing our job correctly. Do you fancy piloting that with perhaps one of your brands, Precise Mortgages, for example, with a specialist distributor around the Essex area?
I think, you know, you were always against trail commission, weren't you, Rob, previously? And I guess maybe that's what it looks like. To go to the question, should brokers be financially penalised if bridging loans don't redeem on time? Josh is right. The responsibility and the partnership lies between both partners. I think what's interesting is that, you know, we rely on our corporate real estate team for some guidance as to when works can be done and things like that. And of course, you're in part of a cycle now where if any of you try to get any building work done, getting materials is a real pain in the proverbial backside. So things do run over timescales. I think what's interesting for me is when you see some of the deals that come to you potentially where someone wants a rebridge, where things have been shoehorned into a term by other lenders, and that's not a great practice, so that they can roll up and gear up as max as possible. But I think there's a real interesting bit for me there that you touched on. We look at the quality of the submissions that we get from our broker partners right the way across our product lines. And certainly we look backward as well to see if there's any trends, if there's any continuations. And I think, you know, Rob, if there was an issue coming out of your business, the first person I'd pick up the phone to would be yourself to say, there's a trend there and that's going on. But I think, you know, in terms of the fee, I'm quite happy to pay it up front to those guys that do it well and pay them well and work with you through the cycle of the loan, particularly in bridging, where, you know, what you don't want to do is see the broker who's introduced it walk away 3/4 of the way through the term and leaving the client to deal with the lender. Okay,
fair enough. All right, let's move on to something altogether more enjoyable than short-term lending community. Let's go a bit more global. Let's talk about the specialist finance market in 2026, which for those non-mathematicians amongst you, that's the next 5 years. So, Caroline, what does the UK specialist finance sector look like in 5 years' time, do you think?
So I think the future looks extremely bright. In fact, I'm quite bold to say that I think specialist is definitely the new mainstream, and also being dominated very much by the intermediary market. You know, obviously, as with many areas of life, we saw COVID, you know, accelerate the rate of change, and a lot of customer profiles have changed. A lot of people have been sadly, you know, cut off from the high street and now needing specialist advice. So I think that's going to continue. And what's interesting, going back on the intermediary piece, actually, what I did see during COVID is that 83% of customers who are looking for guidance, particularly if they were first-time buyers or even home movers, 83% of intermediary share. So, you know, it shows you the extreme. But yes, specialist market. And when I touched upon earlier about the impaired credit piece, you know, there's 6.29 million adults who've got impaired credit looking for a mortgage, you know, again, specialist advice. I think technology will continue to dominate, but I think there'll be more aggregators who will be looking to do all the, you know, the quick lending that won't hit the sides, and also professional advice will still remain key.
Okay, that's very upbeat, brilliant. Emma, agree or disagree? Discuss.
Agree. So I think the role of technology, I'm obviously going to talk about that because that's something that we're very committed to. I think really has a really big place, and I think in 2026 you can expect to see instant sort of processes, instant decision making based on insightful data that can talk to the specialist markets in which we lend. And you know, we often talk about technology doing the heavy lifting of the mortgage process. I see that very much, the trend. But I do think that the balance will be struck between the appropriate use of technology, serving the customer through the broker-led intermediary markets, which we're also committed to, and allowing the technology to create capacity for people to actually do the thinking part of the job that they do. So rather than sort of the computer says yes or no, the sort of the thinking part will happen and the computer will support the process in order to deliver that outcome. So I think it's a very exciting place to be. I agree wholeheartedly with Caroline around the intermediary market. They certainly have a place. You know, in the complexities that are, you know, deriving from post-COVID, more complex needs from customers, the role of the broker is ever more paramount and will continue to be so. So I think we'll see the role of the intermediary become more and more prominent, and I think the role of technology will create a more frictionless marketplace for all of us.
Okay, and thank you. And Buster, as I can hear you screaming, it's tech, ask me the same question, please, because I know UTB have made a sort of a massive investment in Nevo and various other bits and bobs. The next 5 years, what's specialist lending going to look like in the UK?
So for me, I think specialist lending as a whole, it contains some kind of quirk, doesn't it? Right? You know, think mortgage lending I'm talking about here. It's a customer, credit, income, property. There's some weird quirk about it that's pushed it out of the vanilla, you know, sausage factory high street. And what have we just gone through in the last 14, 15 months? It's probably the biggest, you know, it's going to generate a bunch of those quirks that you're ever going to see. So you've got customers taking payment deferrals, you've got people that have gone furlough, people that are going to hit unemployment, therefore credit profile issues. Actually, you know, I think it was Pepper did some research last year and talked about CCJs and the number of CCJs that were getting issued. That was pre-COVID. You think what that's going to be like as we come out and court action resumes and all those sorts of things. So that's bread and butter specialist lending in 2-3 years' time, once those people have got back on their feet and demonstrated affordability. So for me, I think the customers that are eligible for specialist lending, especially mortgage lending, will increase probably quite markedly, although we haven't really seen that happen yet because we're not fully through the economic impact. And I think, going to Emma's point, the technology piece, that's a huge thing. But we can't forget we're specialist lenders. It's not a sausage factory credit score, you know, approach. For us, what we've tried to do is, I guess, get the IT to do the admin, to leave humans to do the value add. You know, I want an underwriter picking up a case and looking at the payslips, looking at the accounts, and making a decision based upon our risk appetite. I think there's certain things the high street can automate that we as specialist lenders actually try to automate, because I think that's what the specialist market is. You need to pick it up and almost smell the deal at times to understand what the risks are. And those sorts of practices are quite hard to automate in many cases.
And Adrian, your business is a business of considerable scale. Right at the start of the presentation, you mentioned number 6, a top buy-to-let lender at the moment. So is that quite difficult to do in a business of One Savings Bank's style, trying to look at things in a very sort of manual way, or is there still room to be able to do that in the next 5 years?
I think the manual piece is at the heart of what we do. Certainly, you know, we've got 3 different brands. So Precise is probably more automated. The machine does a bit of the work. Kent Reliance, you know, very manual approach. Probably what it's really famous for and why it's won so many awards. The fact that you can pick up the phone to an underwriter, talk a deal through, look outside of the box. And I'm not sure a machine can do that. You know, I'll be happy to be proved wrong in 2026, but we'll see. And Interbay, of course, is the sort of complex commercial bit. I think what's really interesting about 26, if I think of it, is I think specialist market becomes a broker market. Let's not kid ourselves. The prime high street boys are going to want to hold on to their clients, and they're going to do everything they can to do that, and to do that themselves, because it's much harder for them to grow their net lending with an upfront market than retaining customers. And probably all of us have got a mortgage here where we're constantly written to saying, do you want any more money? Do you want a new rate? And they'll continue to invest in targeting that direct, in my opinion. So I think that the bit for the intermediary market is specialist is going to grow, and where it's going to be at, to the points that Buster, Emma and Caroline made so eloquently, that, you know, people will have change in circumstances, income, property and credit profiles.
Okay. Let's get you absolutely out of your comfort zone by doing what you all absolutely hate doing the most, which is talking positively about some of your competitors. Josh, I'm going to start with you. Other than your own lenders, which specialist mortgage business do you most admire and why?
Yeah, I'm gonna be a little bit controversial here. I'm not going to really mention anyone here on the panel, although, you know, we have an enormous amount of admiration for everyone.
You're going first here, so they will probably not mention you now. So go on, carry on.
Well,
strike that one off my list, Josh. Yeah.
No, I'm actually going to go for Enra. I'm going to go for the West One Enra Group. I know that's a little out of left field, but the question why, I think we look at how that business has grown throughout the last decade, coming off the back of the previous pandemic, or not pandemic, the market disruption in 08. We think that They've shown leadership. They've shown vision. They have been very successful in growing and not doing what everyone else has done. They didn't just get a banking license and go down that route. Now, they may be applying for it right now, and I may be oblivious. In fact, I have no idea. But we just think that they've done a very good job in starting out with a monoline business and then systematically diversifying into additional product lines, just very systematically capturing market share, but doing it in a sensible way. We've never seen them within our space be one of those lenders who tries to compete for market share by going ridiculously up the LTV curve or ridiculously down on the rate. So, when you look at the scale that business has managed to achieve, we think that they're probably, firmly established. And Danny, forgive me if he disagrees, but as number 2 in market after Together, and you consider how long Together have been in the space, you really have to say, you know what, hats off. They've done a phenomenal job. Credit where it's due.
He will disagree with you, clearly. Making number 1 will be something to disagree with. Emma, same question to you.
Yeah, so interesting question, Rob. Thank you for that. And actually, I am going to pick somebody that is on our panel today, and that's Al Joshua from MTF. I think from a sort of brand perspective and bridging, I think I kind of respect it. It's almost like a go-to brand. If you want to sort of kind of pinpoint what a bridger should look like, for me, it's kind of the guys at MTF. And I know they're very big on service and customer communication, and their values that speak to our brand as well. So I kind of admire the work that they've done. You're welcome, Josh.
Thank you. I'm blushing. Thank you. Can I take my answer back, please, Rob?
No.
But the other brand that actually is piquing my interest, and I kind of like what they're doing, is Alika Bank. I think they've kind of taken the market. They've got a lot of energy. They're very sort of broker focused and outcome focused, and so I'm kind of watching them, with a keen eye.
So they can both have half a vote there instead of Josh having the full vote. Caroline, it's got to be precise for you, isn't it?
Absolutely, all day long. No, do you know what? Do you know what? I didn't actually have a name for anyone, because I think genuinely, I know, and I will give one if I have to. But I think everyone over the last 12 to 18 months has really pulled and actually just, if you think about it, managing pipelines during COVID, trying to keep brokers, communicating, keeping relationships with distributors. I think everyone's done an incredible job. And being transparent in lots of ways. But for me, if I have to really, really choose a part on this panel,
just get on with it.
Kensington. Because I just look at, in terms of the way they do things, they do research, they sit behind their proposition and they find out exactly what customers do want before they launch out. But yeah, they're being transparent, and I think they've done really well throughout the pandemic as well.
Okay, cool. We'll look at that press release next week as well then. So Buster, you feel a bit unloved in the room at the minute, don't you? So you might get a few mentions there, but no one's told you. So what about you?
Well, none of this lot, obviously. There's no love going around, I like the way Josh and Emma have obviously had a chat beforehand, but left us out of it. No, so interesting. Caroline should say Kensington, because mine's Kensington as well. So I remember them back in 95 when they got going, and it was heavy subprime, adding up the rates on +1 for self-cert, +2 for 80%, all of that sort of stuff off of LIBOR. But you look at how that business has changed since the mid-90s and how they've continued to evolve and develop. They really embrace tech, but not at the cost of the customer journey. Massive originator in the specialist space, sort of 1.5 billion or so, I think it was last year. And that might have been 19, but really big player. But the thing about them that I think sets them apart from everyone else is I really love the way they do their marketing. So all of their marketing is, here's our customer, and that's what you should give us. So you think about their hero product, which is all about firemen and ambulance, nurses and that sort of thing. Whereas I think most of us, if we're honest with ourselves, our marketing is more, here's a rate, here's a bit of criteria, but it's not customer, it's not putting the customer out there as a thing. So for me, I think KMC have shown better part of 3 decades an ability to evolve as a business, and are not the business they were back then, but massively successful still today.
You just need to get rid of that hypnotic owl thing. That is just I'm gonna have nightmares about that thing. Yeah, it is. It's like an owl with orange eyes, you know.
It's a bit hungover, that's all.
Yeah. So Adrian, what about you? Who's number one on your Christmas card?
Well, didn't you say specialist business? You didn't say lender. I was going to say Brightstar, because that would obviously get me a few credits, wouldn't it? Yeah. So, but I can't do that, I guess.
Mortgage business, actually. No lender. So yeah, no Brightstar. Lender. We all take it as view that Brightstar is the best, obviously. But
I did have Kensington down, but I had it down for a slightly different reason. And that is, if you look at their model, you look at the securitizations that they've done over the period, and the way they fund that business is probably second to none in the non-bank lender space. I like their offering. I think they do it pretty well. And I think, Craig, who runs it from a sales point of view, is a good guy and has definitely established something over the last 12 months. I think it's probably the fact that three of us have said that is credit to what the guys have done there recently. And also they're not on the panel.
But perhaps they're reasonably glad they haven't been, really, because they've got all the fun.
They wouldn't have got any votes if they had been, Rob, would they?
Yeah. You, I think it's a backhanded compliment that you lot are voting for anyone, really. So there we, All right. I think we're almost out of time, but one very, very quick. If I can just get sort of a 10-second answer to this: will specialist lenders drive their own direct routes to bypass intermediary in the future? So, Caroline, you've already said no, you don't believe that's the case.
No, I don't. And particularly if I look at Pepper, for example, we we try and help a customer repair their credit with a view that they will then go on to another lender who's able to offer them a lower rate, etc. So, no, I agree.
Shawbrook, the Shawbrook jury.
Well,
call in Brentwood.
So no, I mean, we're completely committed to the intermediary sector. So our growth plans are completely aligned to that. So I can't ever really see a future state where a bank like Shawbrook would look to circumnavigate the sort of broker to get to the customer. I mean, that would just be totally against everything that we're here to do. So
okay, fair enough, great. Josh?
Oh, absolutely not. It would be completely inefficient for us to even contemplate such an act. No.
Wonderful. Buster?
Broken record here. I think specialist lending needs the broker market. Brokers broke, let lenders lend, and I think lenders that are investing in the specialist market, time and effort in going direct, are cutting the nose off to spite their face, really.
And finally, Adrian Maloney.
No, 100% intermediaries, and we'll stick that way.
Right, well, there we go. I mean, that's, for me, the biggest point of the whole last 40 minutes. This is a intermediary-led and owned market. If you're an intermediary out there, which hopefully you are if you're watching this, this market is yours. If you're not heavily involved in it now, make it your point to do so. So thank you very much. We're now going to go to the live questions, and we're going to get in our DeLorean car, and we're going to go forward a few days. So this will be now a live section, which clearly this bit is. So from the non-live section, can I thank you all very much for your time and effort today, and thank you all for being so honest and forward thinking. Very good. Thank you.